Hello folks, this is Professor Hector Agostini from Middlesex Community College. This video is aimed at my students in Business Law, LGL 102. I'm covering chapter 16 so you can have it as a review rather than just rely upon the online lecture. So let's go on over to page 356. On page 356 we get into what a corporation is. A corporation basically is a paper legal person that owns a business. We saw before that the biggest problems with proprietorships and partnerships is the unlimited liability that both have. In a corporation, the biggest advantage is the limited liability. In partnerships, they can go after not only your business property but also your personal property. In a corporation, as a rule, they cannot go after your personal property. They can only go after the property of a business. Now, let's say I want to form a business and I only have $4,000. I mean, I need $4,000, but I only have $2,000. So what am I going to do? I will go to the state and file a document called the Articles of Incorporation, and that's on page 361. At the bottom there, you'll see the document I will file. That will allow me to get a charter from the state that I'm in, where I file the document. That will authorize me to sell what I call shares in a corporation. Now, I said I had $2,000, I need $4,000. What will I do? Well, here's what I'm going to do. I'm going to have myself authorized to sell 20 shares, and I'm drawing them out right here, and I will give each of these shares a value of $200. That is called a par value. So as you can see with this block here, this block represents the corporation entity, and the pieces that I'm going to sell, called shares or shares of stock or just plain shares, will represent a piece of ownership. Now, I've got 20 blocks drawn here. I'm authorized to sell 20 shares at $200 a piece. That's the par value. Now, I've only got 2,000. So I will get 10 shares, which will give me $2,000 worth of capital. Now, the capital belongs now to the corporation. The corporation is a paper legal entity, has ownership of those $2,000. They don't belong to me anymore. They belong to the corporation. I must keep that money separate from me. I must also account for it later on. If I don't, I can have some severe legal problems, including tax issues. But I still don't have the $4,000 I need. So what do I do? Well, these are the shares I'm buying for myself from the corporation. Again, notice the corporation is selling it to me. I'm just acting as its employee. I will then sell 7 shares at $300. That raises an additional $2,100. That's perfectly legal. I now have $4,100. Now the other person has bought 7 shares. I still have 3 shares in reserve that I could sell sometime in the future should I need additional capital. There's another reason why I only sold him 7 shares. Each share is considered one vote. One vote per share. I've got 10 votes. The other guy has 7 shares. That means that if we have an election for the board of directors, which is what runs a corporation, I can put myself on the board and I can select myself as president of the board, president or chairman of the board, as well as president of the corporation. Okay? Notice I've got the $4,100 raised. I have an additional 3 shares I can sell in the future should I need to raise additional capital. All right, so let's go on to the next part of this. So now I have formed the corporation, as they point out on page 359. You see the shareholders investing in the corporation. They now take the money, the capital, and buy equipment to hire employees. Okay, now let's go on over to the share certificates on page 363. At the bottom of page 363, when you buy shares in a corporation, they will give you a stock certificate like you will have there on page 363. Whether you buy 1 share or 1,000 shares, they will only give you 1 certificate. On a large purchase like 100 shares, they will mark down 100 shares, so that certificate will represent 100 shares. If I only buy 1 share, they will only give me 1 certificate, but again, it will say 1 share. All right. Now, as they point out on page 362, we'll have an organizational meeting of the board of directors. Obviously, since I've got 10 shares, I will elect myself to the board and make myself chairman of the board and president of the corporation. Okay, now there are other types of shares called preferred stock. Let's stay away from that. They have preference in a variety of things, but we don't want to get into that. I think we should just stay with what's called common stock, and that's exactly what we have on page 363. So when you buy the shares as I sold them to you, or I bought them myself, those are common shares, common stock. All right. Shareholder meetings on page 367. At the bottom of 367, it shows the basic structures. Shareholders have votes. They will form a shareholders meeting. At the shareholders meeting, they will select the people that will run the corporation, which is called the board of directors. So let me just give you a quick rundown as to how that works. Basically, the way it works is as follows. We have shareholders, selects a board, selects a president, and the president runs the company. This is the basic format of any corporation. Shareholders who vote pretty much annually, or it can be every couple of years, but usually annually, forms a board. You have a CEO of the board who will probably become president. Sometimes they select someone else, but usually it's the same person, if it's a small corporation in particular. And then you have the company itself. The company is the physical being that does the production, provides the services to the public. Okay? Pretty straightforward. Now, what about the profits of the corporation? The corporation is in business to make money. Every business is in business to make money when you really get down to it. When a corporation makes money, well, you're going to get what are dividends. Now, you buy shares for two particular reasons. To make money by dividends or by appreciation of the value of the share of stock. So here they talk about the dividends. The dividends basically means that whatever profits the corporation has, they can distribute the share profits to the individual investors on a prorated basis, that is per share, and those are dividends. You will receive the dividends, that's taxable. You could also sell the shares later on for more money, that's appreciation of stock. You'd have to pay income tax on the increased value that you sell it for. So if I buy a share for $200, sell it for $300, that extra $100 would be considered a profit, capital gains. You have to pay tax on it. Now, over on page 368, they mention about the corporate veil. The corporate veil is that, how would I put a veil? It covers you from legal liability. Now, if the corporation gets into trouble, gets sued, as a rule, the shareholders do not get sued because of the corporate veil. If you want to go after people in the corporation that have done maybe something illegally or have done something they should not have done, you have to pierce that corporate veil. And that's one way to hold shareholders accountable. That's why if you're on the board of directors of anything, always remember, you have a certain amount of limited liability, but you've got to be careful what you do because you might be held accountable and responsible for what you've done. Now, over on page 370, they go into more details about the board of directors. Again, at the bottom of the page, it shows you how shareholders vote for the corporation. Board of directors. Board of directors is really the management arm of the corporation. And as I showed you on the previous diagram, they're the ones that are going to be held responsible. Now, you will have a variety of corporate officers, as they mentioned on 371. Those would be the chief executive officer, president, treasurer, and people like that basically run the corporation, and everybody reports to them. Now, let's kind of wrap up a little bit. As a member of the corporation, you have two duties in particular on page 372. Duty of loyalty, duty of care. Duty of loyalty basically means that you cannot do something with the corporation that personally benefits you. If you do something for the corporation, it has to benefit the corporation first and only. Okay? Duty of care. It means that you must be responsible. You must take care whenever you make a decision of any kind that involves the corporation. If you don't, you could be held liable for not properly maintaining the duty of care. Now, because of all the, how would I put it, illegalities of Enron Corporation and WorldCom, the U.S. government passed Sarbanes-Oxley Act, which requires specialized accounting and accountability. And then finally, what happens if you have what's called a corporate takeover? What it basically means, as I showed you before with my diagram, my first diagram, someone tries to get controlling amount of shares. If someone gets 11 of these 20 shares, that person can control the corporation, can dissolve it, can merge it with another company. And that's what a corporate takeover is. So that's why here I want to maintain as many shares in my hands as possible, at least 50% plus one. And finally, multinational corporations, those are corporations that work in other countries as well. Okay, now I hope I've cleared all this up, and if you have any particular problems, give me a buzz, give me an email, or we can discuss it on the online class. Thank you.